Hi everyone, quick disclaimer before we kick off. Myself, David Bird, or also known as ASX Trader, is an authorized representative of ShareX Australia, and this video is for educational purposes only and does not constitute financial advice. A little bit about me: I do have a Bachelor of Education, so I am very passionate about teaching things like I'm about to show you now, and I am a certified financial technician through the International Federation of Technical Analysis. All right, let's get into it. So, for those who don't know anything about me, I do write for mainstream media. You can find all my work here at the Korea Mail, News Corp, etc. I do love all markets, so my precious metals and equities, as well as my crypto. And I was literally just at Australia's largest gold conference last week. And what I'm going to show you is what I showed them to show you why the cycle has just begun and you have absolutely nothing to worry about. And what I showed them in the fact that, yes, there could be a top of a wave coming soon, but the cycle has just begun, just to show you using very clear data why you've got absolutely nothing to worry about. All right. So first of all, I'll just show you my strategy, which is I just go where the surf's at. Okay. So if you think about it, if you're a surfer, you pretty much want to buy a home somewhere near the beach that you know where the surf's going to be good for the next 10 years. That's your long-term investments. Okay. But you also know that not every day the surf is going to be good. Even though you bought the house there in the good surf spot that you know is going to be good for 10 years, there's going to be seasonality throughout that, where there's periods of great waves and there's periods of not so great waves. And then even throughout the good periods like summer, there's going to be days where it's good and bad, etc. as well. Okay. So it's not always every single day for the next 10 years going to be good waves. Okay. Hopefully I'm making that clear, but you know that for the next 10 years, it's going to be good because of all the research that you've done as to why you've done that one. That's what I'm going to show you today. So my whole style to investing is that top-down approach, looking at the big picture, then bottom up. Okay, so I look where the surf's going to be good for the next decade, and then from there, I then do bottom up to then get the best entries on them so that then I can have a really good risk to reward from there. So Craig, our lead head analysis at Master of the Markets, he did this post a while ago around equities versus commodities. And if you've been a commodity investor, you've had a pretty tough couple of decades. Like since 1980, you've only had one 10-year period out of 40 that's actually been good. Okay, so the equities here have appreciated 6,400%. Commodities have only gained 560% during that time. So massive, massive underperformance from here against the equities. Okay. What he's saying here is markets don't see money disappear. Instead, capital rotates. When one asset class becomes overvalued, capital eventually flows into undervalued alternative. Right now, commodities are deeply undervalued compared to equities. And then how the phases of commodity super cycle work is you have that early expansion, which is where your precious metals lead, gold, silver. You then have that acceleration boom, which is where you get your industrial metals and energy, etc., oil, gas, coal, etc. Then you peak, then you slow down, then reset. All right. So even if you just look at the phases of the commodity cycle, even if before I even show you any more data, has oil and gas and everything popped off yet? No, they haven't even, they're still bearish. So even if we just look at that, we're still in the early expansion phase there, precious metals. Gold and silver have started to take off, yeah, but none of these have. Okay, but let's look further anyway. So the hypothesis he's pretty much saying there is he's saying that, first of all, equities need to be overvalued. We'll check that. Commodities need to be undervalued. We're going to check that. And then market rotation. We need to see money rotating out of overvalued into undervalued. Okay, so first of all, let's look at equities. Price to book value, highest it's been since .com. Okay, one thing. Sales PE ratio, highest it's been since .com. Okay, two things. The Shiller PE ratio, we haven't been this high since the tech bubble. This is the Great Depression. So we've only been up here 3 times before, and those 3 times have all ended badly. Okay, so 1929, 25 years of dead money. 2000, we had 14 years of dead money. And funnily enough, we're up at this perfect resistance level again, and we are above 30 again. So historically, the best time to buy is when you get your single digit flip ratio. They're the good times to buy, which was here. Buy there, 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 and there. Funnily enough, since 1980, we haven't had a single digit Shiller-P ratio. Oh, so what's changed here compared to here? I'm going to show you later on. So just take that into consideration. 1980, we've never gone back to our single digit P ratio yet. Throughout all this period here, we did. Let's see what could have changed. The Buffett indicator. Okay, we all know Warren Buffett. 2 standard deviations. We've only been up here 1, 2, 3 times before. And if you look at history, when we were there, we crashed in the 2022. Here, we had the lost decade. And here in the set, we had the lost decade as well. So another indicator saying that things were not pretty when Warren Buffett indicators started to pop off. Okay, and this is a valuation across the board using a big chunk of indicators. So you've got your combined trailing PE, forward PE, CAPE, which is the Shiller, the price to book value, which is the first one I showed you, EBITDA, Q ratio, market cap, which is the Buffett indicator. So you can see we've only been up here 1, 2, 3 times before. Great Depression, energy crisis, tech bubble. This is the 4th time. Okay, so evaluations we can probably safely say are definitely in the excess phase and overvalued. Funnily enough, as he said, money never leaves the market, it just rotates. So every time that your equities are extremely expensive, those red dots coincide with this, which is what's called the gold to Dow ratio. This is how much gold it takes to buy the Dow, which is the Dow Jones Industrial, which is your equities. Every time we've had these extremes, it's marked a bottom on this ratio, and these are 3 monthly charts. So this is looking at big picture. Like that there is 1965 to 15-year window. Okay, this is a 10-year window. So right now we're down at those same levels we've only been 3 times before. So showing that gold is historically undervalued, not in a bubble, undervalued, and we've only just this quarter changed market structure. Like here, just, and this one right happened so fast didn't even change it. Okay, so the biggest mistake people make is that they think price making a new high means that it's overvalued. Okay, if that's the case, then Apple was overvalued at $2, then $3, then $4, then $5, then $10, then $100. How is stuff supposed to go up if it's not making an all-time high? That's how things move. So do not confuse price going up or moving up in, since a while that it happened, that it's actually now overvalued, because what you need to do is look at historical values against other things to show whether or not it's historically undervalued or overvalued on the big macro picture. And here's a chart here showing that actually gold is still, even though it's gone from $2,000 to $4,000, is still historically undervalued. But like I showed you with the equities being overvalued, I'm not going to just look at one chart, because I never just look at one chart when I do all my analysis. I look at hundreds of charts. So let's dive deeper and see what else is saying that commodities and precious metals are still undervalued as well. All right, so we've got that. So if the SP 500 is so expensive, where does the money go? And then often the answers we seek in the future can be found in the past. You heard the odd saying, history often rhymes. Before I go into the next part, I need to teach you something first. You need to understand the market movements. Once you understand that, I'll be able to break down exactly what's going on with everything. All right, so how the markets move is they move in these 3 phases: the accumulation, the public, and the excess phase. When something's in the excess phase, it's expensive. When something's in the accumulation phase, it's cheap. And all money does is rotate out of expensive in the excess phase into cheap in the accumulation phase. And that repeats over and over and over and over and over again. And often when something's in the excess phase, it's so shiny and bright and exciting, everyone's looking at it. They're not looking over here because this isn't moving. So it's boring and it's dull. No one's talking about it. And that's often when the best opportunity. So everyone's talking about gold and that now because you're in that kind of excess phase of a wave, which I'll explain soon as well. Okay, we're into that grid phase, but then that will reset. So where you are in gold right now is kind of this part. So you've had the first move up, you're in it, and then you're going to get that correction, but it's still got further to go on the upside, but I will explain that soon. But you just need to know accumulation, public excess. Excess phase is expensive, accumulation is cheap. All right, so you get your movements up and then you retrace the whole move back down to a Fibonacci retracement zone. And how the markets move is they move 3 steps forward, 2 steps back. The reason why most people lose money in the market is because most people get involved in something when it's in this excess phase. And when it's in that excess phase, that's where it's exciting. It's moving fast. It's moving really rapid, like really quickly. Everyone's like, oh my God, I'm going to get rich. And they come in and they buy somewhere in here, could be here, could be here. But then they make money in the short term and then they end up giving it all back. And often what happens is the market comes right back and wipes out that whole excess phase because you throw that, comes back and it comes back to the norm, which is your normal trend. Okay, and again, I'll show you that. Again, don't take my word for it. Let me show you using data that this is how the markets move. So this is our Australian 200 index. So here you can see the accumulation phase, the first move, the pullback to the zag zone, next move up, pull back to the zag zone. This was the tech bubble pop. I'm sorry, that wasn't tech bubble. That was the 86 correction. And then see here, really fast, really rapid. That's when you know you're in the excess phase. Okay, accumulation, public excess, 2 steps back to the 618. Okay, that 87 crash that you've read about, one of the worst crashes in the financial markets, it actually was just 3 steps forward, 2 steps back. Okay, so again, remember how I said anyone that comes in that excess phase will get wiped out. Anyone that came in during the accumulation of public, they'll be pretty. Okay, but anyone in the excess phase, when it was exciting and was talking about it, they get wiped out. All right, you never ever want to buy something in that excess phase because they're the things that can financially ruin you, which I'm about to show you on the next one. So remember how I said then that becomes of the next one. So that's the 87 crash there. So zig, zag. That then becomes the accumulation of a bigger cycle. So accumulation, the public, this is the tech bubble pop. And then again, can you see the excess phase? Really fast, really rapid. So the GFC, the great financial crash that ruined everyone, the reason why it did is because what it was doing the 3 steps forward, 2 steps back of a 25-year bull market. See, that now went from 1980 to, so I'm back to 87, hang on, 87 to 2007. So, you had that 25, 27-year bull market. But again, only the people that got caught up in the excess phase got financially ruined. If you got caught anywhere in the accumulation of the public, you're completely fine. Okay, but 3 steps forward, 2 steps back. Okay, so the GFC ruined the early chasers that came in the last few years of that bull market. Okay, over and over, and then that now would become the accumulation of a bigger cycle, and it just goes over and over and over and over again. So here, the COVID crash, again, from the GFC lows, first move up, zag retracement, next move up, zag retracement, next move up, 2 steps back, 618. So again, 3 steps forward, 2 steps back. So the COVID crash that again was the end of the world, it was because it was correcting that, what was that, 12-year bull market. Okay. So now you've got a little bit of education around how the markets move. Let me show you those things in the market today. So the thing we're looking for is we want to buy things in the accumulation phase or the beginning of the public. Well, you don't want the very bottom of the accumulation. You want kind of like towards the end of the accumulation. So somewhere around here is where you're after. You don't want anything in the excess phase. The NASDAQ right now, okay, we saw all the valuations showing that it's up in that, extreme money is going to rotate from the, now let's look at the charts and see the same thing. And you can see the accumulation phase, the public participation phase, and now you're in the excess phase. This is the exciting part. The part where people, oh my God, the NASDAQ has done 20% a year for so many years. I love the saying, skate to where the puck is going, not where it's been. Yes, that's where you wanted to be for the last 20 years, but it's not where you want to be for the next 10 years. Okay, because we're in the excess phase. Money will rotate out of the NASDAQ, out of your SP 500 into what's undervalued. Money rotates from paper assets into hard assets. Where did you want to buy the NASDAQ? Down here, when you broke out of the accumulation phase, beginning of the public participation phase. This part, beginning of this macro bull cycle, not the end. Okay, so knowing that we're getting our 3 steps forward, we're going to get that 2 steps back, just like we did here in the tech bubble as well. Okay, now let's look at commodities. So I'm going to show you a couple of key charts, then I'm actually going to go to the gold chart and the silver chart and show you where we are in those cycles so you can stop freaking out. All right, because once you see the big picture, you'll know that it's very obvious and there's nothing to worry about. All right, so gold to Dow ratio, I've shown you that. Okay, we've only just broken out on the quarterlies of 3 monthly candles. So that's only happened .com, energy crisis, Great Depression. Funnily enough, the same periods when equities were super expensive, just broken out in the quarterly. This is your gold miners to gold ratio. So how precious metals work and how any asset class works, whether it's real estate, whatever, money goes into the best of the best first. So it goes into the actual physical asset, which is gold. Then once it gets into gold, and it runs up and it stays there, then all of a sudden the gold miners go, oh man, gold's not coming back. It's staying there. We're now making this amount of money. And then they start being very profitable. Okay, so then money starts to rotate into the gold miners because they're just a leverage play of the gold. And then they go up, then the developers go up. And then at the very end of the cycle, the explorers go up. The speculative, and they haven't even found gold yet, but they're looking for gold. Okay, but gold gets expensive, then the gold miners get expensive, and then it rotates into what's cheap next, which is the gold. So that rotation I'm talking about from commodities to equities, etc., also happens within its own asset class, which is it goes into the asset, then rotates into the producers, and then when they get expensive, it rotates into what's cheap, which is the developers. Then when that goes into the explorers, and then when everything's up, there's like, well, nothing else is cheap, cycle's done, rolls over. All right, so again, looking at that ratio, knowing that does this look like it's in the excess phase or does it look like it's in the accumulation phase? We've been going sideways during this period here, okay? It's in the accumulation phase. The cycle's just begun. This is the American GDX to gold ratio. Again, you've only just broken a 19-year decline and you're still within the accumulation phase. Is this in an excess phase like back here? Okay, no, nowhere near. Here, the GDXJ, so junior miners to your your larger miners, producers. So like I said, money will rotate into the smaller cap ones. Okay, this was the top of the cycle last time in 2011, the bull market. We've been in a bear market. It bottomed in 2015, which is when gold bottomed, commodities bottomed. And it's been going down in this ending diagonal, what's called a falling wedge, which is accumulation. You've only just, again, these are monthly charts, not daily, not weekly, monthly charts. You've only just started to break out now after, this 3-year accumulation base. So again, does this look like it's in the excess phase or the accumulation phase? It's in the accumulation phase, only just breaking out, beginning of the public. All right, so beginning of something, not the end. The GDX gold miners ETF. So this is your gold miners. All right, they have only just on the quarterly, so 3 monthly candles, taken out the high from 2010. That's when gold was around that $2,000. So gold's $2,000 there. We've only just broken out and now gold's $4,000. That doesn't make sense. The gold miners, then these should be twice the price as well, higher up. Okay, see the disconnect? The gold miners are still cheap compared to the gold. It's still the beginning of it. These have been in a bear market from 2010 until now. This is a bear market. Does this look like an excess phase to you? No. Okay, beginning of the cycle. This is your junior miners. Top of the market. We've been in a bear market. It then has been going sideways since 2013. Okay, it's only just this year broken out of a decade-long sideways trend. Does this look like accumulation phase or excess phase with the junior miners? They've been a terrible investment for over a decade. Again, these are 3 monthly charts, big picture stuff. Has the cycle just begun, or is it end and you had the excess phase? Very obvious where you are. Okay. When I talked about silver, I wrote about it back in March. I also, as you guys know, follow me on YouTube, called the exact breakout back in April 2024. Okay, here it is here, silver. Oh, sorry, May, 13th of May, 2024. As you can see, I'd never done a video about silver before that because it wasn't bullish until that point. So in 13th of May, 2024, MTM students know we got back on it in March and April. But that's where I did put it on YouTube there, talking about the big picture stuff and how we've just turned bullish. Silver was about 20, it was 24 when we got, I think it was about 27 bucks there. All right, let me show you where that is. Okay, that is April, May, that's here. Okay, so we're breaking out here in that May. All right, so back at, 26 bucks. Okay, we're now double that. We were double, we're up. But again, even if you just look at this picture right now, can you see 5 phases? I can see the first move, the pullback, and I can see that we're in the public participation phase. Okay, nowhere near an excess phase yet, but I'll unpack the big picture of that later on once I give you guys a bit more info first. All right, so I did a YouTube video back then. I've been banging on about it for a while. I also wrote about it in the mainstream media back in March of this year when we're, I think, at $31, talking about that it's about going on a major move, and it did, okay? Here, assets cheaper than 1980 price. What I want to show, again, looking at that asset rotation, when Buffett said, sorry about the missing the T, said it's to sell silver swords. You can clearly see when equities are in that bear market, silver goes into a bull market. When equities are in a bull market, silver's in a bear market. Equities in a bear market, silver's in a bull market. Equities in a bull market, silver's in a bear market. So now that Buffett indicator like we saw is hitting sell again, which historically has meant equities bad and now silver good. So again, these are monthly charts, big picture stuff, looking at it. Has the cycle just begun or is it over? Okay. So again, I did this back in May. We're up a bit further now. We're sitting around here, but the cycle's just begun. All right. Looking at the big picture, forget about daily noise. Here's another chart showing the same thing. The silver to NASDAQ ratio. We haven't been down at this level before since literally the .com crash. Okay. So down here, and funnily enough, we're down here. We've just changed market structure on the monthly, by the way, keyword monthly, on bullish divergence. Okay. So we've come down here back at this level and we've just changed market structure. So a 5% pullback, you won't even actually notice it on this candle. What's happened today, the 7% pullback, you literally won't even be able to identify it on the big picture times to come. That's why it's so important to zoom out and see where we're at in the cycle. Gold to silver ratio is still up in the 80s. Okay. Show me a time in history where a commodity cycle, the gold cycle, has topped when this ratio is above 50. Okay. It does not happen. As you can see here, this is the top of the commodity cycle. Last time we were down at the 28, and other ones in the 1980, you were down at like 17, 18. All right. So again, the ratio, silver is still cheap compared to gold now. Again, this is big picture, 3 monthly stuff. Okay. What you need to remember, guys, is these cycles run over 10 years. It's not like crypto where you get a bull market for a year and it's all over. Okay. So silver's not going, this ratio is not going to come down here and the whole cycle's done this year. This goes over 10 years, goes over many, many years. So you need to understand the ebbs and flows of the market, that they zig and they zag. There'll be good times and bad times. The recent run we've just had should not have happened. It should not have moved that fast. So now it's punishing those latecomers for those people that came in and FOMO'd in at the top. They'll be okay in the long run still, but they weren't in buying it for the long term. They were in it to try and make money rich now. So they're going to hurt for a few months, maybe a year or so, whatever it is. But in the long run, they'll still be okay. The silver miners, it costs about $27 to get this. So every dollar that it's above, they're printing money. So even now, silver's come back to that 48, 49. They're still making bucket loads of money right now. Okay, they're printing money right now. So let's look at silver. Last time silver was here, we've gone a bear market. Again, is this accumulation phase or is this excess phase? You've only just this quarter broken out of, again, a decade-long base. It's not the end of a cycle. It's the beginning, like the beginning of the cycle. You can clearly see it. It's only just broken out. If that was a daily chart, you'd be buying that right now. Okay, it's been a terrible investment for the last decade. Now you've just broken out again, 3 monthly candles. These are your junior miners. Again, been going sideways, doing nothing for the period. You've only just broken out on the 3 monthly. Platinum, I wrote about back in May as well. Okay, when it's down here again, see massive bull market. You've been in a bear market for 20 years. Okay, you've only just first move up, pull back. And when it was down $1,000 is when I talked about that it's going to be the thing. And, it's gone from $1,000 to $1,600. Is that the end of the cycle? Let's have a look. Let's look at platinum. Platinum, last time we were down here in the 70s, well, it started back here, but even pull back to here, top of the channel. Okay, these are 3 monthly candles. Once we peaked in 1980, you then from 1980 until 20-year bear market. You got caught there, you were done. Yes, top of the excess phase will financially ruin you. 20-year bear market. Then from that 1997 up until there, you had your bull market. Again, if you got caught at the top of that cycle, then yeah, your financial ruin. You then again went into another 20-year bear market. You've only just broken up from this level. So coming up, it will go above 5,000. You got to remember, platinum historically is more expensive than gold. Gold's $4,000 right now. So even if this was to go back to the ratio, it will come up to around the $5,000 mark minimum. That's if gold stops going up. Okay, you can see where we are. We've just come out of a 20-year bear market. Do we have a 20-year bear market? 6 months up and then the cycle's over? No. Worst case scenario is that you get something like this. You pull back before you go. Okay, that's your worst case scenario. But I don't think we're going to get that because that's what this was. The first move up and your wave two. All right, so yes, we might get a move back to the 1347, major support resistance, that kind of thing there. That would become probably my worst kind of target. But again, open to it, but it's okay even if you're wrong. Again, you got to remember markets are like a butterfly. They're very erratic. And, if you're trying to predict every little move that it does, good luck. But you don't need to. But you do need to know, is the butterfly going south, north, east, or west? And that's all that matters, is we know they're going north. The butterfly movements along the way to get there, who cares? Okay, and this is where people try and get too smart for their own good, is they try and time every little zig and zag. And what they do is they get it right one time, and the one time they get it wrong, they never get it and they never get back in, and then they miss out on the move. Trust me, I've done that. Where I've, nailed it thinking I was so smart, then next minute it doesn't do what I thought, goes up, and I was like, oh, because it's really hard to time the smaller time frames. As Dow theory said, the small time frames is manipulated noise. It's not even worth trading. You need to trade the primary trend. And look at all the data I'm showing you as to where we are. Okay, so again, cycle's just begun, not ended. See, we're looking at so many charts saying the same story. The platinum to silver ratio, we haven't been down at this level since those 1970s on the last commodity cycle. So silver's cheap to gold, but platinum's also cheap to silver. But again, 3 monthly charts, long-term investing, not what's going to make me money next week. All right, the small caps, same thing. We've had massive divergence in the large cap to this. They've been really charging out the last 3 months. we've only just broken out on the quarterly now as well. It's still down 10% from the GFC peak. They've been a terrible investment throughout that whole period. Okay, absolutely terrible. But again, look what they did last commodity cycle. Went from 1200, they did a 4x. Okay, so that's a bull market. That's the excess phase. Can you see that quick rapid movement here anywhere? No, we're just breaking out of the accumulate. This is the beginning of something, not the end of something. Okay, the Canadian market has been going sideways for 25 years. You've only just broken out. Again, these are 3 monthly charts. Yes, they can come back a bit. If you bought today, yeah, you might have a bit of short-term pain, but big picture stuff, you can see where you are in the cycle. Okay, this is our small cap to large cap ratio. So when this is going up, the small caps outperform the large cap. You can see we've only been down here 4 times before. We've just crossed bullish. We're doing it again now. Again, these are 3 monthly charts, big picture stuff. Okay, the cycle has just begun. You had a big candle. Yeah, you could have a few days, few weeks pullback. That's normal. Okay, but big picture, the cycle has just begun. Okay, so should you worry about a crash? You know, when the tech bubble crashed, we had an 80% pullback. What you've got to remember is when the tech bubble happened, the ASX 200 only fell 22%. And our small caps only fell 30%. All right, crashes are part of the cycle, but it's also about, remember, you're not holding the excess phase, because I just shown you, we're not in the excess phase. So any pullback is the normal ebbs and flows of the market. If you're in the NASDAQ right now and you start getting it, then you've got to be like, ooh, is this the end of the cycle? Different story, because all the evidence is pointing towards that being in the excess phase, the exciting part where things are moving rapid and fast. Okay, here you can see it. NASDAQ, excess phase, yes, that will financially ruin you. That didn't financially ruin us. What's the difference between Australia and NASDAQ? We have 3% tech. Okay, we're a very commodity rich country, just like Canada as well. So we thrive during a commodity cycle. America doesn't. Again, you can see when something's in the accumulation phase, something else is in the excess phase. All right, see, excess phase in the Australian market, accumulation phase in the NASDAQ. So you know that our Australian market now, again, these are 3 monthly charts, so for the next decade. And then when you start getting towards the top of that one, then we rotate back into the NASDAQ, because then it will be the opposite. This will be cheap and this will be expensive. And that's it. That's all you got to do. Investing is really easy if you know how to look and where to look at the markets. Okay. Yes, America is overvalued. That's even higher now. We're not. We're still fairly valued. Okay, we're not expensive. So why does this happen? You got to remember, bonds move the world. So we had down market here, 1940 to 1980. We were in an increase in interest rate environment. Okay, so not so conducive to growth, etc. This 40 years down, this has been a decrease in interest rate environment, which is why I talked about with the equities, they've been really thriving during that period, because money's been cheap. And when money's cheap, you borrow lots of money and companies grow. But now we've broken that cycle in 2020. So 40 years up, 40 years down, broken up. We've broken the decline. We're probably going to be in an increase in interest rate environment for a while. Okay. Again, there'll be ebbs and flows along the market. I'm expecting a pullback, but then I'm expecting interest rates to go higher again. Okay. Inflation to come back, all that money printing makes sense. Think about where we are in the cycle. Why is money piling into the gold? To protect wealth. Okay, because we're going to be moving into that same kind of similar cycle. All right, so going back to what Craig was talking about, we haven't had these take off yet. So we're still in that early expansion phase, which the charts are also showing you that we're in the beginning phases. We know oil, gas, etc. Like, let's look at that. Let's look at them and see where they're at. All right, let's look at oil. Oil's been in a bear market. So it's in a bear market. So this isn't taken off. So we haven't hit phase 2 yet. Okay, I would be looking at oil because you know where the money is going to be going next. Okay, because money will rotate within its own cycles, remember? Okay, but right now it's not there. Let's unpack our gold and silver, etc. So gold, looking at it, what you've got to remember is the biggest mistake people make, remember, is that they think something make an all-time high or that it's run hard means that it's expensive, right? You've got to remember that gold went sideways for more than a decade. It's only just broken out a year ago for the first time. It was sideways until then. That's a sideways market. So do we correct for 12 years, go sideways, and then we go up for 1 year? Is that how cycles work? No. Okay. We've only just, from that period, from there to there, broken out. Like, let's look at it in context. Just broken over sideways movement, and look how long the last cycle went for, or the other cycle went for. Okay, so you can see within, let me go into the 3 monthly and I'll show you. Now you can see the cycles within. Accumulation, pullback, public, pullback, excess. Okay. Once you had that full blown bull, and it went from $34 up to $800, you had a 20x, not a 2x, a 20x. It then, yes, 1980 would have financially ruined you because then you actually had a 27-year bear market. Horrendous. You don't come out of a 27-year bear market and then you come up for a couple of days and then it's all over. Okay, that's the next cycle that then corrected. This is, so where we are in the cycle is so zig, zag, that's a big cycle there. This here is the beginning of the public participation. So this is wave 1 of the public participation. So that's actually the accumulation phase. Pull back. This is the beginning of the public participation phase on the bigger macro cycle as well. All right, so it's still got, like, that's the big bear market. Then you've got a smaller bear market for 14 years. All right, so wave 1, wave 2. This is again the public starting to get involved now. Because where are you? Right in that middle of the public. Public has done it. I was speaking to Jordan, the general manager of ABC Bullion, at the gold event on Tuesday, and he's like, it's funny watching how it's going because gold's been almost like he didn't say the word cool, but it's like exclusive. It's like we're different. We like gold and no one else likes gold, and we've got our own little exclusive club kind of thing. And he's like, it's starting to change. Like, people are starting to come around and like gold now. And it's not that kind of, you're in your own little unique club kind of thing. It's like, it is really starting to change. And that's because we're moving into the public participation phase. Okay. During this phase here, the accumulation phase, it's not cool because you got to think what came before that, a 30-year bear market. So it was really not cool to like gold from 1980 to there. All right. So you can start to see where the psychology is perfectly matching the wave cycles as well on the bigger picture. All right. Public starting to get involved, and you wait to the end of that and then the excess phase, and it finally gets into its big thing. And I'm not saying it's going to 50,000, by the way. I'm just drawing pictures. But you'll be like, gold will be, amazing. And then when it's amazing, like it was in 1980, boom, you get multi-generational bear market again. All right. So these cycles just play out over and over and over and over and over again. What's cool now? AI, NASDAQ, you know where you are in the cycle. And let's look at silver. So silver, same thing. This was the big bull market from 1930 to 1980, had a 50-year, so bear market, nasty bear market. From your 1930 to 19, you had a 50-year bull market. Again, accumulation, public, excess. And what you'll notice is, remember, 3 steps forward, 2 steps back. He came down the Fib 500 perfectly, straight to your zag zone. So big 50-year bull market, bear market from 1980 to there, 15-year bear market, done. Okay, so that there was the big cycle. So that's all now the accumulation of a larger cycle. Then where you're at is then again 1, 2, 3, 4, 5. Okay, so then the next move up, and what you'll notice is the exact same thing. That one comes down to the public participation phase. Again, did 500. Okay, so that there was correcting the 50-year bull market. This move from 2011 to 2020, the 10 was correcting this bull market. All right. Does this look like the beginning of a cycle or the end of a cycle, or even of that kind of wave? So where are we? This is the accumulation phase. This is the public participation phase of the bigger cycle. You've literally just begun. You will be kicking yourself for even thinking of freaking out now on the, again, 3 monthly charts. Okay. Yes, it might come back. It might, come back to even $37 or something like that. It maybe come back to there. It might, who knows? Again, I don't care about butterflies, and I don't have to care, because where did I position myself here? I haven't FOMO'd in now. In the long run, you won't care anyway. But this is the beauty of putting in the work early and knowing, because you've got the buffer for the butterfly to stuff around and kind of freak people out. But again, look at where, so again, technicals matching beginning of a cycle as well. Okay. All right, back to presentation. So, we did a precious metals event at ABC Bullion September last year. Okay. And when we were there was, throughout that period, a handful of people were in the store. Okay. And then we held an event in Sydney just recently at Sydney Live, had about 180 people come, and we were giving out silver coins as a prize. And I told my brother to go and get some before. And he's like, there's just your lineup outside at ABC Bullion. You've been seeing it all over the news. So what does that mean? Doesn't that mean we're in the excess phase? But remember, there's waves within. So this is literally what I said on Tuesday at the gold event. Top of a wave will come soon on gold, but the cycle has just begun, just like I've shown you. The market zigs and zags, but the primary trend is up. Okay, so there will be pullbacks along the way. That's healthy and normal. But there's so much evidence as to show why the trend is still up. So I literally wrote about this October 13, which was 9 days ago, talking about you've missed the gold rush. This is how to catch the next big run, and just talking about this exact thing. Okay, that, we were in there when gold was $2,000. Now they're here. The psychology of late stage buying for that wave, etc. People aren't interested in stuff when it's undervalued or out of the spotlight. All right, and this is what I'm about to get to soon. And what you're looking for is value before validation. People aren't going to cheer for you when it's the best time to buy. It'll be the opposite. If you're buying gold right now, everyone's cheering, oh, good idea. Yeah. Okay. Will be in the long run, but in the short term, they're going to get punished a little bit. All right. So where I believe the next quite opportunity is that oil, because we know where the phases are. All right. So just a little tip there. Look at the next one. Skate to where the puck is going, not where it's been in the short term. Big picture is still very good. But if you're looking to make money in the rotation within its own cycle, that's what you're looking for. Okay, so then how do I do the bottom up? So this is where when you cook a recipe, you get your ingredients, and then you get a method of how to do it. Same thing with trading or investing. Okay, I have my recipe, my ingredients. These are the ingredients I use, and then I put it together for my plan. Okay, from there. So let's look at how I've done that. Gold, October 2022. I looked at seasonality. Okay. From there, I then went, using my Elliott waves. I knew, okay, this green zone's your area of reversal. And then from there, knowing where we are in the cycle, I combine my confluency with seasonality with that to know that, okay, gold may have pullbacks along the way, but the primary trend is still very much up and has a lot more potential to stack them bars. Okay, as you can see, perfectly reversed there and went up from there. Okay, and all that was during that low there, what do you think everyone was screaming during that period? Double top, oh my God, it's going to $1,400. You break support for two reasons: continue the trend or grab liquidity. So then when it did that, I noticed bullish divergence coming in. I was like, oh, okay, interesting. Bullish divergence coming in into the change of market structure. Then I went and got indices must confirm. So when gold made a new low, Northern Star, funnily enough, did the opposite. It made a higher low, then another higher low. So why is a leverage play on gold outperforming the actual gold? Because that was showing bullish divergence into Northern Star, showing the bullish divergence. That's how I was able to get Northern Star down there at that $6.90, which is when you saw me post about it on socials, etc. I know Jamie still loves me for that one. All right, so indices weren't confirming. Then when I looked at Northern Star, why did it come down here? Grab all the stop losses, change market structure back through, volume didn't confirm the move, boom, you confirmed the low. All right, I then went and got more confluency, Evolution Mining on October 18th, 2022. It's doing this falling wedge on bullish divergence, bullish divergence. So then once we had a high level above 215, boom, I added it into my position. Then when we also had the 5 waves up, got the pullback and did the chain, I then added to my position again to bring my average of Evolution to, I think it's $2.50 or 60. Okay, so added on the reversal and then re-added on the change of market structure on the breakout. That's here. This is where Evolution Mining is now. So looking at where we are, accumulation, pullback, public, pullback, excess. So yeah, when this excess phase finally realizes, you're going to probably come back somewhere back to around this $8 mark. That doesn't mean that it's over. It just means that anyone that bought the final phases is going to get wiped out in the short term because they're buying to get rich. Smart money was buying at the end of the bear or the breakout. We're still very much up huge amounts. So as a trader, you'd be looking to lock in profits soon. But as an investor, you know that it's normal for it to come back to that end of that wave there. Then in gold, October 2023, same thing. Looked at the seasonality. I talked about this is what I call start zone technicals, macro and timing, all saying the same thing. Lots of signals, just need the confirmation now. All right, so gold underperforms February, September. It outperforms from September to February. So I was looking at it. So, oh, okay, things are looking good. That's there. That's the wave 2 low. So 1, 2, 3, 4, 5 up. Zag retracement before the move. So again, accumulation, pullback, public. You're in the excess phase of this wave. It will correct at some period, and very likely when this phase is done, come back somewhere down around this mid 3000s. Okay, once it's finalized. You can see we're in the excessy phase because of the movement. See, it's really fast, really rapid. This is what gets people in. But on the bigger picture, absolutely nothing to worry about. Remember, it was only 2 months ago that we were back here. This should not have happened. This is that late stage FOMO buying. On that same day, I then went, indices must confirm, went looking at Northern Star. First move up, pull back to the Zag zone, down here on this 10, bullish divergences. And I was able to then, again, re-add to my Northern Star position and at that $10 mark. Okay, so what you've got to realize is when something's in that excess phase, something else in there, and what smart money does is they make you look left while they go right. So when something's in the excess, it's really shiny and exciting. Something else is in that accumulation and you're not interested because it's shiny over here. So if you look at gold, even if you miss the bottom there, like I got the bottom there, why didn't you get the breakout? Look at it. It's literally textbook break of resistance. Resistance support flip. Like it could not be an easier, like it's the easiest setup, like stuff you could do within the first 2 weeks of my MTM course, you could have got that. So why wasn't everybody on gold at $2,000? Because when something's breaking out of the accumulation phase, something else is in the excess phase that's dangling a carrot, distracting you. What was that? Crypto. Okay, so when this was breaking out of the accumulation, public, excess. Okay, this was in the excess phase. Okay, so that's why you were distracted, because that, remember, was the Bitcoin ETF, everything. And from there, what's it done? it's been in a bear market while this has been in its bull market. All right. So that's why you miss it, because you're getting distracted by something else. So don't go where people are talking about things. You got to look for the next opportunity. And this will be opportunity again once it's finalized. Once this finally tops out and corrects, people are looking over here. This could be opportunity again. All right. Because then people weren't looking at it. And I talked about this. Investment your lifespan having right now in silver, most are blinded by crypto. They make you look left while smart money is going right. Silver's been selling for 40 years, bigger the base, bigger the exposure. This was April 4, 2024, when silver was down at $24. Okay, everyone was talking about crypto during that period. You had Bitcoin, all these kind of things. And silver has outperformed all of them, even Bitcoin, since that period. Okay, and also looking at the bigger macro picture, it's only just started the cycle. Bitcoin is a little bit tricky because it hasn't been around long enough to know where we are in the cycle yet. But from that perspective, that's where it's at. All right. And same thing, October 2024, gold, the SP 500, it just changed marks, just broke out. Precious metals likely to outperform equities for many years. Most people are waiting for the alt season as they're chasing yesterday's gains. While they look left, smart money is going right, and they'll miss the metals season. Microcaps will be pumping like alts. Life-changing wealth we made for those that know where to look. So this is last year, October, like this time last year. Okay, what happened during there? Trump trade, crypto. Everyone was really looking at the alt season. Oh my God, I'm going to get so rich. And yet the life-changing wealth was in the metals during that period there and then. Okay, people were looking left while they went right. And now there's memes around it. Like all of a sudden the crypto bros are talking, that kind of stuff. All right, so markets are easy if you don't follow the herd. They're designed to lead the herd to the slaughterhouse. Okay, so another perfect example, and then silver going there. So, back again, gold continues to make new highs. So back in April 2022, I talked about the fact that it's gone. You're going to get a local top. The market will punish latecomers. I'm looking for a local top, somewhere that's 37.50 to where it is. Okay, I then was talking about, guys, it doesn't mean that it's over. I was then talking about the next day, so April 22, it's 3 days later. It's still bullish, but just not where the short-term opportunity is. Something from the last post, what I meant is that you'll get multi-month consolidation, wave 4 price action. And this is where gold remains bullish in its structure, but then money will rotate into the silver, platinum, etc., and gold miners. So talking about the triangle forming there. And that's exactly what did happen. Okay, from there, we started to form the triangle and we started to, then that's where silver, platinum, palladium started to outperform gold. It was just the rotation with its in cycle. So again, fear and greed, we're up in that extreme greed. Seasonality right now, it's typically bearish during this little period here, but then we move into the bull season. So let me show you that period there. So from April until that period. So let me go back and show you. Okay, that was here, April. And then what did we do? We did that perfect triangle I was talking about, multi-month consolidation, April until August. We had the triangle, multi-pause. While that was happening, the other metals thing, rotation, the opportunity was done. From that triangle, we've now broken up. Okay, we've had the breakup from there. I want you to see that April until August, and then from September up, we've had the move. Let me show you that within the seasonality. Okay, goldfish. So here, coming up to the areas, so April, coming down, this is supposed to be bearish. Then it bottoms in this kind of late August. Okay, August, pumps up. And then typically this October period is bearish. So when you see that, so bear market here, bottoms late August, really bullish. Then bearish here. Let's look at that within gold. So here, April till August, late August, we were bearish. Typically really explosive during this August to October period. okay, like we saw, then so we're, just seasonality wise, it's supposed to pull back here because you get this explosive move up that then, as we know, market zig and they zag. Massive zig. It should not have moved that fast. Normal pullback. But then look what comes. Bullish season. Up until kind of like that February, March. So what I'm expecting now on gold is you're going to get that pullback. Where it comes to, not sure. But you'll get that wave 4 pullback into that kind of November period. Then you should get one more big move up until that kind of February period. Then you're looking for that bigger correction. Okay. That correction there will likely also coincide with the major top on the NASDAQ as well in 2026. So this should be just a normal, just correcting this little move here. Then you get your final big move up. But then after that, that's where then you're going to get a big correction from the whole move, which will likely bring it back to there kind of thing. All right. So again, gold's not where the short-term opportunity is, because anywhere here, even if you get that move there, it's going to get wiped out. So, this is all just going to be, so short-term people are going to get slaughtered, which is why those people are lining up. They're getting rich quick. And then by the time it does all that, and then it finally gets back up, what are you looking at? A year, 2 years later, and their get rich quick plan failed. But on the larger cycle, it's still very bullish, but they're not there to invest for 10 years. They're there to make money now because that's what they had been doing. Okay. So that's what I'm seeing, guys. And again, I could be wrong with that because, of the butterfly. But this is the beauty of knowing where you're on the cycle is it doesn't matter if I'm wrong on the short term because I know the big picture is up. It's only if I was doing this on the NASDAQ right now where it would financially ruin you, because if you're wrong on the short term, you could be wrong on that bigger term, which is where then you can get absolutely slaughtered buying in that excess phase. But because of all the data I've just shown you as to where we are in the cycle, like this is what the highest probability is a pullback now for seasonality, and then that big move up until early next year, get that blow off, then we get the major correction. Another reason why I don't think that's a top, so many people were calling a top. And I'm telling you, when I called that top there, no one agreed with me. Okay. Oh man, it's going to go 5K by the end of the year. And that was me. And I'm like, man, I've been a bull literally for 2 years. And the first time I write something bearish and then you're calling me out on it, really? So the fact that everyone's calling a top there, to me, it's just that perfect. We're coming in. You'll hear the narrative money's going to move out of gold into Bitcoin. Let's just look at Bitcoin now and see what it's doing. Okay, so we've had that move up here. Everyone saw the bearish move, but if you unpack the move, volume has not supported it at all. Okay, so that move there, volume hasn't supported. If you look at the hourly as well, you can see it. So volume not supporting it. A lot of sell pressure starting to come in. So for me, I'd need to see a higher low here and that kind of up there, because at the moment, that to me just looks like a manipulated move by whales, knowing that gold had topped, then it crashed. And then everyone going, oh, if gold's topped, that means Bitcoin's bullish. And then they've loaded up and it's the FOMO trade. But right now, volume's not confirming it. So what I would need to really see is, before I can go bullish on Bitcoin, as you can see, there's no change in market structure yet. Okay, no change in market structure yet. It's still lower low, lower high, lower low, lower high. I would need to see that higher low and that to happen. Okay, and then get these both. If I get that, then yes, I would go long, but then I'd still be careful in the zag zone there, because it might just come up, fill the FVG gap as an A, B, C, which might align with the correction on gold. And then I'd like to see what happens there. So yeah, really, I'm not comfortable until we start clearing back above the 120K, but I would still do at least a change of market structure, but just be on guidance there. But at the moment, yeah, volume's not confirming the move yet. But we'll start to see let's see what the 15 is looking like. Start to see what's going on here. All right, so what you'd be looking for now is buyers coming in here. So you'd be looking for a change in market structure off here. And if you get that, then yeah, you might get that next move up. But until then, just be careful with that, because like I said, I'm not seeing a major top on gold yet. I'm just seeing a short-term pullback just for, tops a week, maybe 2. And then I'm actually seeing an explosive last move up on gold, which we'll start to see how that affects this stuff as well. All right, but I guess the main thing I'm trying to show guys is when you zoom out, look at the big picture, okay, I'm very comfortable having my house right there on that gold commodity trade, that precious metal trade for the next 10 years, because I know the surf will be good there. Yes, there'll be periods of bad in and out, but this is the beauty of being in early, is these kind of pullbacks. It's like, well, I'm already up 180% in 1 year from it. So what's a 6% pullback? If you've bought in the last week or 2, then you're underwater. So then you got to be like, well, hang on, why did I buy now? Because everyone's talking about it. That's when you go, okay, well, I'm okay with that because I'm holding long term. And it's amazing how people go, I'm holding this long term, but the minute they buy, they want it to only be green. Okay, and that's very rare unless you're a professional, like someone like me, where it's like, you get in early. But even when I bought, silver at $24, it wasn't green straight away. Like I think I went in to draw down maybe 5% or something at some point as well. Like, but remember, you enter on data, you exit on data. You don't enter on emotions or when you're feeling uncomfortable. That's a different thing. All right. So green doesn't mean right. Red doesn't mean wrong. You've just got to look at the big picture and understand where you are in the cycle. And I've just shown you an overwhelming amount of evidence to show you where we're at. So for all those things would need to change for me to then think otherwise. Remember, they were monthly and 3 monthly charts. So if you look at gold and you look at what it is, 3 monthly, like this drop that you've just had, it's actually, can't even see it on the candle. Okay, so gold would have to go below 3,800 before you even get some red on it. Okay, looking at the monthly, still, so like I said, you won't even notice it on the chart in years to come. Okay, so big picture, guys, only you know your game plan, which is why I was talking about it before. Okay, so October 18, which was 4 days ago, I said at the gold event on Tuesday, I told the room, yes, we're getting towards the top of the wave, but the cycle has just begun. I wrote about it again on Monday's paper, like I just showed you. If you're chasing short-term profits, fine, take them, because yeah, you don't hold things in the excess phase. But if you're building generational wealth, remember this, you're standing at the very early edge of a much bigger move. We're just entered typical seasonality. A month or so of pullback wouldn't surprise me. It's healthy. Cycles always test conviction. Those that understand where we are in the timeline will be ready for what comes next. Top of a wave, not a cycle. If you can't handle the zags, you don't deserve the zigs. All right. So knowing where you are, this is why I'm not even going to flinch about today, because when I bought my positions in silver, now again, I wasn't holding it for 1 year. I got them because I was holding them for many years. All right. So the market, the ebbs and flows of the market will go on. I wasn't expecting silver to be up at $55 now. Like it moved too fast. So now it's coming back. All right. Hope that helps, guys. And helps you kind of stomach what's going on and knowing your plan. If you're in it for the short term, then yeah, that's where you got to think, oh, well, do I know how to read charts and do I know what I'm doing? Because then you're trying to trade against professionals like me. And then you got to kind of start think about it. All right. So long-term investments, absolutely nothing to worry about. All right. If you like the video, guys, please like and subscribe, share the love, and I'll catch you on the next one. Take care, everyone.